Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is AutoZone Incorporated, ticker AZO. Over the next 5 minutes, I'll discuss both the valuation of this company and my thoughts on its business quality. First up is the industry. This company is in specialty retail. They have a market cap of $38 billion. They retail and distribute automotive replacement parts and accessories. They offer various products for cars, SUVs, vans, light trucks. All sorts of products. These basically have retail locations. They operate 6,000 stores in the United States, 600 in Mexico, and 53 in Brazil. So I've seen these stores. They are, distributed all around the country, and basically they have those specialty parts for automotive. Now, interesting thing here is beta of 0.91 indicates maybe it's a little bit less volatile than your average company, but that's a relatively good sign that indicates maybe this is more high quality. Now, return on invested capital. These numbers are amazing. I love everything I see here. This looks great. So first thing we see is that the lowest return on invested capital was in 2002 of 21%, and it's risen since then fairly steadily, but to a new plateau up in your 30% range. Also, what this tells you immediately is they have 20 straight years of profits. That's a very strong sign for the profitability of this business. We love to see this, and so very excited by everything I'm seeing here on return on invested capital. Great numbers, very good indication of a high quality business. Now, return on equity. This is where it gets really interesting. When you look at these 10-year median returns, you see return on assets of 14.9%, return on invested capital of 41%. All of these numbers are very, very good, very high quality. But the first thing that leaps out is going to be negative return on equity. There's two ways you get negative return on equity. One is losses, but you can clearly see they are not losing money. And two is negative book value, which is what we see here because you have a price to book value is negative 12.2. And so this means that you have a negative return on equity, not because you don't have profits, but because you have profits but a negative book value. This is actually a very good sign. What this indicates is they have been buying back so much stock that their book value has gone negative. And so they've been able to buy this stock because of these high returns on invested capital. So that's why you see a positive return on invested capital but a negative return on equity. It all looks good here. And as we go into the later statements, you'll be able to see how that happened in those statements. The price to PE ratio of 15.9 is very reasonable. For a company with these metrics, I like this valuation. This looks very attractive as a potential stock to consider buying for me. So now, what do we see here on 10-year CAGR? We do see that revenue has grown slower than assets. And so that would explain why over the last 10 years, you've seen a drop in return on invested capital. That's not generally a good sign because what we're saying, we can see in 2012, we're at 43% return on invested capital, but now we're at 32% return on invested capital. That's okay though, because these numbers are still amazing. Anytime this number is above 10 to 15% and you get into those 20 and 30% ranges, you're very, very strong in terms of your business quality. Now, the other redeeming factor is that although assets have grown at 9.5%, your free cash flow and EPS have grown much faster than that. So this EPS difference between free cash flow is likely being boosted due to share buybacks, which we'll get to look at later on. But you can clearly see the great returns there. Now, what I like to see next here is you can see that not only is revenue growing steadily every single year revenue is growing. That's good. So it's not just single bumps and it's not very cyclical. You like to see that. In addition, your gross margins are very stable. The lowest year is 51.5%, and it's increased steadily every year since then to 52, well, besides 2020 to 2021, 52 to 53%. So you've had a stable, strong gross margin in the 51 to 53% range. Very good. Indicates a relatively high quality company. So you can see they have this operating leverage from 18.9% to 20.1%. That's a good sign. But even then, we take this further and we can clearly see their earnings per share have grown amazingly over the last decade. You've gone from 23 to 95, over a 4x or about a 4x in earnings per share in that period, which is very strong, very attractive for investors. Now, what you'll see is this entire period we've had negative return on equity, which means we need to go to the next statement in order to figure out why that is, and I'll show you that in a minute. Before we get to that, don't forget to like this video if you like what you are seeing so far. Hit that subscribe button and ring the bell so you can get notifications as I upload new investing content each and every week. So let's go to the income statement, and here you'll see what I'm talking about on shares outstanding. You can see that they've taken shares outstanding from 39 down to 22 over the course of the last decade. They've bought back almost 50% of their shares in only 10 years. So it's like a 6 to 7% buyback rate on an annual basis, which is very, very attractive for you as an investor. And so you can see that those buybacks have driven that big change. Let's see now. The next one we need to do is balance sheet. And so what we'll see on the balance sheet is, so they've tripled their PP&E. So you've gone from 2.6 billion to 7.5 billion. But what's going to happen here is shareholders' equity is negative. So the shareholders' equity being negative means that they have more liabilities than they do assets. How does this happen? This happens because if you buy back shares above book value, then over time you're going to have to mark this number down. And so even though your retained earnings are there, your retained earnings have gone negative, not because you're losing money. Look, they have negative retained earnings, but what's happening is they're still making income every year. So how are they getting negative retained earnings? And well, when you go to your cash flow statement, you can see, look, positive cash flows from operations. Very positive cash flows from operations. But look at this, net issuance of common stock. They are dumping money into share buybacks, which is destroying it's removing all of that from the balance sheet. And so you can also see they do have stock-based compensation, but look at the difference here. $33 million in stock-based compensation, $1.2 billion in stock buybacks. $63 million of stock-based compensation in 12 months, $4 billion in stock buybacks. They're absolutely destroying their shares outstanding. They're constantly doing this, and then they're keeping leverage on the business by keeping a net issuance of debt on an ongoing basis. And this is not because they can't fund the business. It's because they're using all of their cash flow from operations to buy back shares. Look at this. All of their cash flow from operations is going into share buybacks, and they're just destroying those shares outstanding. You can see there's no dividends, but they are clearly dedicating their cash flow to buying back shares. So, do I like this company? Absolutely. This company is both a very high quality. You're steadily having 20 to 30%, sometimes 40% return on invested capital, which is leveraging the return on equity to be something like these extremely amazing numbers in the 75% range. They do have debt to support that ongoing return on equity above return on invested capital. They're growing at a reasonable revenue rate, 6%. They're trading at a reasonable valuation of 16. All of these numbers look great, amazing, very excited about what I have seen here today from AutoZone. And to me, it would immediately go on my watch list because I want to buy companies like this that have good capital allocation. They're retiring their shares outstanding, and they have strong returns on invested capital so they can self-fund all their growth. And they're putting that money into stuff like buybacks. They're also trading at a reasonable valuation. Everything looks good. Stars are aligned with AutoZone, going on my buy list. Going on my watch list to look at more detail. Thank you for listening. Please don't forget, like this video so that it can get shared with more people. Please subscribe so you can get more investing content as I work through every company in the S&P 500. By ringing that bell, you can get notifications as I upload those new videos. Thank you for listening, and until next time, stop paying fees, start building wealth.